Once we've prepared our master budget as we did in the context of Chapter 8, this sets the stage for how we are planning on operating. But at some point, we will have to go back and assess what we've done. It is not necessarily a good idea to go back to that master static budget and compare it to our results. First of all, that master budget is what we also call a static budget, and it was based on one activity level that we assumed would happen. It's very unlikely that that assumed level actually did happen. So if I compare the actual results, which could be on a different activity level than what that master budget was created, then I'm not going to be doing an appropriate comparison because they are on two different bases. So what we do instead is we create what's called a flexible budget. There are actually two applications of flexible budgets. One of these is just a modification of the master budget. Instead of preparing it for one level, you could do it for several levels. For example, we may think that our sales for 1 month may be 10,000 units. But let's create that master budget for 9,000 and 11,000 units as well, so that I can basically see what would happen if we don't exactly achieve our goals of 10,000. That's really just creating multiple static master budgets. The true flexible budget is when we go back in and we take the actual activity, the actual units that we have sold, the actual number of customers we have served, and we are going to recast that master budget using that actual data, but we're still going to use those budgeted rates. After all, it was a budget. The idea is, if I recast that master budget at the actual activity level, I can compare that to the actual results to say, if we had exactly achieved this, given our estimates, did we spend more? Did we spend less? What really has happened here? And this is a good comparison. It's a wonderful comparison for us to do. And of course, we're going to look at these variances, and as we've seen previously, if variances are immaterial, we pretty much put them to cost of goods sold, but if they are significant, which we call material variances, then we probably need to allocate them as necessary. And that again stems back from some earlier material that we've looked at. So let's look at some examples of how we do a formal flexible budget. I've got a simple example here, and I'm only looking at one specific budget, not the entire master budget, so I can just illustrate the point. We have a company that is budgeting 2,000 units for a given month. The company feels as though it can sell them for $30 a unit. The variable costs, which would be your materials, labor, variable overhead, are planning on being $12 a unit. The fixed costs down here, which could be your fixed overhead, which could also be including some of your period costs as well, are $25,000. So we think the overall income is $11,000. But here is what happened during the current month. We did not sell 2,000. We only sold 1,800 units. You also didn't sell them for $30 a unit. You sold them for $29.50. The variable costs were actually $11 a unit, which was $1 less than what was originally planned. Fixed costs were exactly the same, and in general, fixed costs are somewhat easy to predict because we don't expect them to change. Now that's not to say they can't. For example, rent. We may have to renegotiate our rent during the year and it could increase. It could also decrease, but in general, most fixed costs are pretty easy to predict. So if we look at this results and we try to compare it to the budget, here is what would be the conclusion. You would say the sales, which were expected to be 60,000, which are now only 53, that's a difference of 6,900, which is unfavorable. They are lower than what we had planned on. The variable costs they're actually less than what was budgeted, and so this is a favorable result. We spent less than we thought we would. The contribution margin, though, is lower. That would be unfavorable, and the bottom line income is lower. That is unfavorable. There is no variance on the fixed cost because they're the same. That is neither favorable nor unfavorable. In fact, we say it's a neutral variance. Given what we have just analyzed, the overall conclusion would be we're more unfavorable than favorable, and so we would have a negative opinion on, say, for example, this manager's results of operations. And we may go in and chastise this individual inappropriately, and this could have devastating effects. The big concern is what we just did was incorrect. We are comparing a 2000 level budget to an 1800 actual level activity. So by definition, if you sell fewer units, wouldn't you expect your revenue to be lower? Wouldn't you expect your cost to be lower for variable purposes? And the answer is yes. So these are not very meaningful results. Instead, here's what we should have done. We should have done it on the same activity level, which means go back to this master budget up here, this static budget, recast it using these budgeted rates, but on a basis of 1800 units. So I'm going to take 1800, multiply it by 30, multiply it by 12, and rerun this analysis. And here's what I did. So for the actual activity at the budget, I did indeed take the 1800 units and multiply by the budgeted price of 30. I took the 1800 actual, multiplied by 12. Of course, the fixed is still the same, and here's the income. Now, I just copied that actual data down here so I can do a comparison. Now, when I do the comparison, given what we have actually achieved, we were planning on making 54,000. You only made 53,100. That's only a 900 unfavorable variance this time, which is a far cry from the 6,900 we originally said. As far as the variable costs, they are actually lower given what we should have done at 1,800 units. It's still favorable in this case, but it's not quite so much of a difference. Now, I want you to notice that I didn't keep the same signs going on because I don't want you to fixate on the signage. It's not to say that anytime you're negative it's unfavorable, or anytime you're positive it's favorable. That is not true. You can put a sign in there if that helps you, but you really just have to assess yourself and see what is really occurring. If the actual revenue is less than planned, then that would be not a good result, unfavorable. If the actual costs are less than planned, then that would be favorable to you because you saved money. So you can put your signs in there however you wish, just make sure you rationalize it appropriately. Continuing on, the contribution margin here is overall favorable, and so is the income. So if you notice, if we had done this assessment, we have concluded that the person is overall unfavorable, whereas when you look down here, there are much more favorables than unfavorable. So we would have been making a terrible assessment if we had done the original. You must create the flexible budget to do an appropriate assessment. So what you would then do is go in and try and address what's really happened here. So I would essentially say, why did we make fewer sales? Why? So I would go in and talk to the manager. I said, okay, we thought the budget was going to be at $30, but you actually did it $29.50. Why is it less? Well, perhaps there were some additional competition factors that we had not planned on. So if a new store opened up down the street selling exactly the same thing for a cheaper price, we're going to have to lower our price to be competitive. That's a perfectly good explanation. As far as variable costs, wow, how did you save $1 per unit here? Maybe we got a discount because we paid early. Maybe we got a discount because we ordered so much volume. Maybe we got a trade discount because we're a good customer working with the supplier. Find out why so that you can explain this and try and replicate that or extend it in other areas of the business. So I just put a few little comments down here in regards to this, and I said, well, aside from your sales, the overall performance looks really good, but our price may be dictated by the market, which is really beyond our control. So again, we are back to the controllability principle. Remember, that just basically says that only hold managers responsible for things they can control. Now, I do want to look at a couple other examples of these, and we're going to do these out of your textbook. So the first one I want to look at is exercise 1 in chapter 9. This is on page 412. Now, the notes that I have provided to you are already complete on this one so that we can just look at what I've done here. In the first case, we're a diving company that does basic repairs underwater. And you can see that their budget, their master budget, their static budget, their planning budget, whatever you want to call it, was based on 100 diving hours. They're estimating that revenue would be $365 for every hour. And you can see the expenses here. Some of these are mixed, such as wages and salaries. There's a fixed component plus a variable component, $125 per hour. Some are purely variable, like supplies. It's $3 per hour. And then some are purely fixed, like insurance. It's just a flat $3,400. So those are all of our budgeted amounts. We're told in the requirement that the company's actual activity was 105 diving hours. So that's the actual. I cannot compare that to the 100 because they're on two different activity levels. So the exercise basically says create a flexible budget on the actual activity. So I'm going to use 105 here in lieu of the 100, and then I'm going to take that 105 and then just use that in all those rates that we had to recast it at the actual activity. And I did all my formulas at the side here so you can see what I've done. And after recasting this, you can see that our income was $7,500, which is actually more than what the results would have been. And again, this is pretty much expected. If you do more hours, you should have more profits here. Now, we don't have the actual results to compare this to, but this is the first step that we would take so that I can do budgetary assessments. So to do this assessment, I wanted to look at exercise 4. Now again, we have everything completed here, and I want to discuss what your chapter calls a budget performance report. A budget performance report consists of, here is your master budget, here is your flexible budget, and here is the actual activity. Now, remember, the actual are the real results. The budget is the master budget, the planning budget, the static budget we're expecting. And then we take the actual activity and recast it at the budgeted rates to get the flexible budget. Now, let's see how we come up with this flexible budget data. In exercise 4, which is on page 414, all I've basically done is take these three columns as given and just replicate them up here for me. Now you can see that we have all of those rates again over at the side, how much the revenue is expected to be per budget. The wages again were a mixed cost, the fuel is a variable, and so on. So you can go back and recalculate them if you so desire. Now, once I have all of this recalculated, then you're going to note there are two variance columns here. Now your textbook shows the calculation of a variance as the difference between the budget and flexible budget columns. So if the master budget said $16,000, the flexible budget is $15,360 on revenue, and that difference was a shortfall of $640, unfavorable. And I'll do this all the way down. You'll note I've put this is a very weak approach. Consider this. When I compare these two together, numerically, I can see there is a difference. And yes, the flexible budget is less than the planning budget, which makes it look like you didn't perform quite what you wanted to do. Unfavorable. However, this goes back to what I just mentioned. It's an inappropriate comparison because they are on two different activity levels. This variance here that your authors suggest calculating is very meaningless. In fact, for me personally, it's worthless. I would never calculate this in a realistic setting because it does not tell me anything. What really matters is comparing the budget, given what you actually did, to the actual activity. We thought, given the budgeted rates at actual 48 flights, you should have had 15,000 revenue. You had 13,000. You had less. That's an unfavorable variance. That's meaningful. So I'll compare all of these costs to the actual and get these variances as well. And of course, for the overall effects, I'll do the comparisons here to get those. These are the variances that we want. These are the ones that are useful to me. So we could go in and say again, wow, your revenue is so much less. Why? Well, obviously it's going to be a little bit lower because you have 48 instead of 50, but we've compensated for that. When you recast that budget at 48, it takes out that 2-flight differential. So now you're looking at just the dollar rate impact. Why did you sell them or charge the customers less per flight than what you planned on? Why? Was it because it was an economic condition that people didn't have quite as much disposable income, so we had to lower the price to attract customers? Was it because, again, competition opened up, and to be competitive, we had to lower our price? Find out why. As far as, for example, wages here, you actually spent more than what you planned on doing at the actual. Why? Did you hire a new pilot who was a little bit more skilled? Did you have to give a pay raise? What happened here? Figure this out. For fuel, why did you spend more than you planned on? Did the price of fuel go up? Was there some waste? Did you accidentally spill some? What happened? That's what these variances will help you assess. The comparison of the budget and flexible budget variances tell you nothing. So even though it's shown in your textbook, and I've put weak approach here, in actuality, I would never do this in my business. It gains me nothing. The only variances that are helpful are this last one over here. So the flexible budget is the follow-through after we've done a master budget, and it's always important when you do budgetary assessments that you do make sure that when you go back and compare your actual results to that budget has been recast on the same activity level so that I can get meaningful comparisons.